Why Buffett rarely checks stock prices. Imagine waking up to discover one of your biggest investments has dropped 15% overnight. What would you do? Open your trading app? Panic? Sell before it falls even further? Now here's the surprising part. Warren Buffett, one of the greatest investors in history, would probably do nothing. In fact, he has often said he doesn't need to know what his stocks are doing every day. That sounds almost impossible in a world where prices flash across our screens every second. So why does one of the world's richest investors rarely check stock prices? The answer might completely change the way you think about investing. Most people believe successful investing means staying glued to the market. Every dip feels like danger. Every rally feels like opportunity. But Buffett believes this constant attention often creates emotional decisions instead of smart ones. His secret isn't ignoring reality, it's focusing on what truly matters. He's not buying ticker symbols, he's buying businesses, and businesses don't fundamentally change because the market has a bad Tuesday. Think about owning a small bakery in your neighborhood. Would you ask someone to tell you its value every 5 minutes? Of course not. You'd care about whether customers keep coming back, whether profits are growing, and whether the bakery is building a strong reputation. Buffett sees publicly traded companies the same way. When he bought shares in great businesses like Coca-Cola or Apple, he wasn't planning to flip them next week. He invested because he believed these companies would continue creating value for years, even decades. Constantly checking stock prices can become an addiction. Every notification triggers excitement or fear. Psychologists call this a variable reward system, the same mechanism that keeps people refreshing social media or pulling slot machines. Investors who constantly watch prices often mistake movement for meaning. But price is simply what someone is willing to pay today. Value is what a business is truly worth over time. That's a powerful distinction. Buffett has often emphasized that the stock market exists to serve you, not instruct you. Market prices are invitations, not commands. Sometimes they offer bargains. Sometimes they're irrationally optimistic. Your job isn't to react to every mood swing. It's to make thoughtful decisions when opportunities appear. Imagine planting an oak tree. You wouldn't dig it up every morning to check if the roots have grown. You water it, protect it, give it time. Wealth works much the same way. Patience allows compounding to perform its quiet magic. While others chase headlines, disciplined investors let strong businesses grow, earn profits, innovate, and reinvest year after year. So how can you apply Buffett's mindset? First, reduce how often you check your portfolio. Daily price movements rarely improve long-term decisions. Second, spend more time learning about the businesses you own than watching their share prices. Third, measure success in years, not days. Great companies build wealth slowly before the results become obvious. Finally, remember that emotional discipline is just as valuable as financial knowledge. The investor who stays calm often outperforms the one who reacts fastest. Warren Buffett rarely checks stock prices because he understands something many investors forget. Markets are noisy, but businesses tell the real story. The greatest fortunes aren't usually built by those who watch the market every minute. They're built by those who choose exceptional businesses, trust the process, and allow time to do the heavy lifting. The next time you're tempted to refresh your portfolio, ask yourself one simple question. Am I investing in today's price or in tomorrow's value? Sometimes the smartest move an investor can make is not another trade, but the patience to do absolutely nothing.